Our next cost is real cost and prime cost. Real cost or actual cost are those which are actually incurred by the payment of labor, material, plant building, machinery, equipment, traveling and transport, etc. The total money expenses recorded in the books of accounts for all practical purpose, the actual cost. Actual cost comes under the accounting concept. On the other hand, prime cost refers to all such of expenses which can be directly assigned to the production of a commodity. It consists of direct material cost, direct labor cost, and other direct expenses. We can say prime cost equal to direct material plus direct wages plus direct expenses. The next is urgent cost and postponable cost. Urgent costs are those costs that are necessary for continuation of the farm's activity. The cost of raw material, labor, fuel, etc. Maybe it's examples which have to be incurred in production to take place, and the cost which can be postponed for sometimes, that is whose postponement does not affect the operational efficiency of the farms, called postponable cost. For example, maintenance cost which can be postponed for the time being, and this distinction of cost is very useful during war and inflation. Then out of pocket cost or book cost. The item of expenditure which involves cash payment or cash transfer, both recurring and non-recurring, are known as out of pocket cost. All the explicit cost, example wages, rent, interest, transport expenditure, etc., falls in this category. On the other hand, there are certain actual business costs which do not involve cash payment, but a provision is made therefore in the books of accounts and is taken into account while finalizing the profit and loss of accounts. Such expenses are known as book cost. And in this way, these are payments by a farm to itself, depreciation allowances, and unpaid interest on the owner's own fund are the example of book cost. Then fixed cost and variable cost. Fixed costs are those which are fixed in volume for a certain given output. Fixed cost does not vary with the variation in the output between zero and certain level of output, and the costs that do not vary for a certain level of output are known as fixed cost. And fixed cost includes cost of managerial and administrative staff, depreciation of machinery, building and other fixed assets, and maintenance cost. And next is variable cost. Variable cost are those which vary with the variation in the total output. They are a function of the output. Variable cost include cost of raw material, running cost of fixed capital such as fuel, ordinary repair, routine maintenance expenditure, and direct labor charges associated with the level of output, and cost of all other inputs that vary with output. It's called variable cost. Then total, average, and marginal cost. Total cost represent the value of total resources required for the production of goods and services. Then average cost is of statistical natural history. It is not actual cost. It is obtained by dividing total cost by total output. You can say actual cost equal to total cost divided by क्वांटिटी, जो भी हमारे टोटल आउटपुट। Okay. Then marginal cost. In addition to the total cost on account of producing an additional unit of the product, or marginal cost is the cost of marginal unit produced. Then marginal cost equal to change in total cost divided by change in quantity. Then short run cost and long run cost. Short run cost are those costs which vary with the variation in the output, the size of the fund remaining same. In other words, short-term costs are the same variable cost. Economists define the short run as being the time period when at least one of the factor of production completely fixed. For example, a particular company, this might mean that they have reached full capacity in a warehouse or at the factory side. This short-run cost consists both fixed and variable cost. And short-run costs are accumulated in real time throughout the production process, and fixed costs have no impact of short-run cost. Only variable cost and revenues affect the short-run production. Variable cost change with the output, and for example, employee wages and cost of raw material. The short-run cost increases or decreases based on variable cost as well as the rate of production. If a firm manages its short-run cost well over time, it will be more likely to succeed the reaching the desired long-run cost and goods. On the other hand, we can say long-run cost are those costs which are incurred on the fixed asset like plant, building, machinery, etc. Such costs have long-run implication in the sense that these are not used of in single batch of production. In contrast, economists define the long run as being the time period when all the factors of production can be changed. So, in the example above we have discussed, we can now look to expand its warehouse or factory capacity without any problem. Then private cost and social cost. Private costs are those costs which are incurred by a firm in producing a commodity or service. For a firm, all the actual costs, both explicit and implicit, are private costs. It is a cost incurred in the production process by the producer, including tax and profit margin that are anticipated, and private cost for a producer of a goods, services, or activity includes the cost the firm pays to purchase capital equipment, hire labor, and buy material or other inputs. And private costs are paid by the or consumer and must be included in production and consumption decision. Then social cost. Social cost implicated on the society at the time of production in this sector, and their social cost take the form of pollution, damage to the forest itself, and other economic deforestation, natural resources depletion, etc. And the value of this social cost can be estimated with the help of contingent valuation method and other method used for valuing non-market goods and services. Then accounting cost and economic cost. Accounting cost is based upon accounting records in the books of account. and costs are recorded in the books of account when they are actually incurred. Accounting follows accrual concept, so costs are entered in the books of accounts when these are occurred, and accounting records are based upon the legal transaction of a business, and accounting costs are those costs must explicit cost and must be paid. Asset as per asset as part of accounting cost are valued at book value. Then economic cost consists both explicit and implicit cost. In other words, economic cost include both recorded and unrecorded cost. Assets are valued at represent cost, that is market value in case of economic cost. These are types of cost. Next is cost function. Cost function expresses a functional relationship between cost and output that determine it. And in symbol we can say C, which are saying cost equal to FQ. Q is output quantity. The cost function refers to the mathematical relation between cost of a product and various determinants of cost. In cost function, the depend variable is unit cost or total cost, and the independent variable are the price of factor, the size of output, and any other relevant phenomenon which has a bearing on cost. This is all about cost analysis and cost function.